Dear students, today we're going to learn about foreign exchange markets. It's a good thing to learn so you don't make expensive mistakes by buying something that you saw was inexpensive when it was really super expensive. So pay attention and you'll enjoy this. See you soon. This video will focus on foreign exchange, spot markets, and forward markets. In finance, an exchange rate is the rate of which one currency will be exchanged for another. It's also regarded as the value of one country's currency in relationship to another country. Foreign exchange sometimes is defined as foreign exchange or forex or FX. The foreign exchange market has a turnover of $5 trillion per day. And as such, it's the largest over-the-counter market in the world. The spot trade, also known as a spot transaction, refers to the purchase of or a sale of a foreign currency, financial instrument, or a commodity for instant delivery on a specific spot date. Typically, the spot price is the price of a security, or in this case, a foreign exchange, like a currency, right now. Where the spot market is pretty much right now, the forward market is forward-looking. The forward market is an over-the-counter marketplace that sets the price of a financial instrument or an asset, typically currency, forward for future delivery. Forward markets are used for trading a range of instruments, but the term is primarily used with reference to the foreign exchange market. It can also apply to markets for securities and interest rates, as well as commodities. Mark Twain said, "If you don't read the newspaper, you're uninformed. If you read the newspaper, you're misinformed." And that's why I always recommend my students to read Al Jazeera, the BBC, CNBC, The Economist, Reuters, the Hong Kong Times, the Sydney Times, and Moscow Times, and so on. Every country has a major paper, and many of them have news printed in English. And that makes it easy for you to actually find out what's going on in the world. Everyone has different likes, wants, and needs. And so it's a good way of finding out what's happening with your neighbors and yourself sometimes. So if you want to really find out what is truly happening in the United States, you might want to read a Canadian paper or a Mexican paper. Why? Because the United States is their biggest trading partner, and they have a different view. They're not anchored in what is politically correct or incorrect or right or wrong in Washington. They care about what will actually impact their trade. Other great websites is the Bank of England, Bank of Japan, the European Central Bank, Federal Reserve, and also the Forex.com and the International Monetary Fund.org. Now, these pages here have a ton of great resources that you should use for your research, because they have hired so many economists and analysts that are writing these reports that you should use them. Don't try to come up with a similar report. Don't reinvent the wheel. Go and grab good information and then just reference where you got it. Finance is always forward-looking. Accounting records what has happened as a historical record. So when we look at finance and we're looking at the present value of future cash flows, we typically look at what is the initial cash outflow. That's our investment, buying a new building, buying a car or a truck or something. And then we assume that we will actually make some money on that investment. And that means that we take the cash flow, divide it by 1 plus the risk premium, and then to the power of how many years it might be. And if this series of cash flow, and you can just multiply this whole cash flow string, is greater than the initial cash outflow, the cost of the investment, and that you have a positive present value or a positive net present value, then you invest. However, you might have a limited budget, so you have to decide and calculate on what project has the lowest risk with the greatest return, because that's the one you take on first, and then you go down in priority. Investing takes time, a lot of time. In the currency markets, time horizons are actually in seconds. The long term in the foreign exchange market might be 10 minutes. Now, the option market has a time horizon in days and sometimes weeks. Most standard contracts are settled in the United States on the third Friday of each month. The stock market has a time horizon of months, years, or the next sector rotation. However, Warren Buffett would say that a good holding period of time for a stock is forever. So, stocks don't mature unless they go bankrupt. Now, on the other hand, the bond, on the other hand, they have a time horizon that is equal to the next coupon payment, which is typically every 6 months, unless it's like a Fannie Mae that is based on mortgage-backed securities, which means that payments are monthly. Now, a good way of understanding different types of language when it comes to the government's government-issued bonds, you have Treasury bills, T-bills, mature less than 1 year. Treasury notes, T-notes, mature less than 10 years. Treasury bonds, on the other hand, matures for a time period greater than 10 years. So you have a T-bill, T-note, T-bond. International finance will also allow you to make risk adjustments given the changes in interest rates. When there's a change in interest rate, it also has an impact on the change of the underlying currencies. You can also estimate the political risks like elections, value sociology, loss and barriers when it comes to market imperfections, expanded opportunity sets as a currency appreciates or depreciates against another currency. And then you can see what kind of opportunities might there be. Are there new technologies that are coming out? What are the trends? And naturally, currency risk of inflation and deflation. So here's an example of the Dow Jones Industrial Average on top. And it appears that it actually appreciated during a short period of time 7.2% between August 1st and November 1st, 2010. And that's when it's priced in US dollars. Now, if you price the Dow in euro, for example, that means that you take each data point and divide it by the spot price, the historical spot price for the euro, and then you divide the Dow into euros and see if you had any change. And when you look at it that way, there was actually no change at all. It was very flat. So in this case, during these 3 months, so from August, September, October, and November, okay, well, it's roughly 3 months, you would actually have inflation of 7.2%. You really didn't have any progress. And that's another way of measuring risk. You can look at it that way to see, are we actually doing better, or is it just that we're making money on exchange rate? You can also price oil the same way and see how it changes in price. And that way you can use not only a stock market, but you can use the oil market or a commodity market and price it in different ways just to see and estimate if your company, if that sector that your company belongs to has a firm specific inflation that you need to take into consideration when you calculate on your projects. Because if you don't calculate for that inflation that is currently happening, then you might not be making money, but rather losing it. So that means that you have to adjust your prices to meet that change. You should never fight the Federal Reserve because they actually own a printing machine. So during 2008, 9, and 10, and partly of 2011, the Federal Reserve was printing money in something they called the quantitative easing. It was a period of time when the Federal Reserve added trillions of dollars of liquidity into the economy, also known as quantitative easing, or QE 1, 2, 3. Then they renamed it to Operation Twist. Then it turned into be tampering, and then they called it stealth, and so on. Mainly because the market didn't like the whole concept of the Federal Reserve printing money. So here you can see the fluctuation of interest rates that the market was trading for the 10-year Treasury notes. So here it was trading around 4%, and then they announced QE1, which pushed the interest rates down during that period of time. What they did is that they actually went out and bought, so they printed money, took that money, that cash, and bought treasuries. And they bought it from investors around the world to push out liquidity in the market. Or they might have just bought it directly from the Treasury Department in the first place. And then when they stopped, the interest rates went up. And then they announced it again, that they were going to do more. And then they, pushed the prices down on, that's the interest rates down. And then as soon as that stopped and increased. Now, if you looked at the stock market, you will see how that would impact the stock market as well. As money was flowing in, and the stock market is inflation protected, you will see that the stock price would increase, yet it would not really have real progress. But it makes people feel rich, and that's sometimes what's important. The foreign exchange market, the FX market, that is the largest in the world. It's open for business 365 days a year, 24 hours a day, and long term is 10 minutes. Now, when it comes to arbitrage opportunities, that they exist for a fraction of a second. Okay, that's risk-free opportunities of making money. They're typically found today by supercomputers that the banks have on like 9, 12 digits out. And profits are then made by trading billions of dollars in fractions of seconds. You can't do this by typing on your keyboard. You have to have a computer that does it automatically. Some other terminology that is good to know is that FA brokers, foreign exchange brokers, buy and sell currency for a fee. But remember, they do not take a position themselves. International banks, they look for arbitrage opportunities to buy a currency for their clients. Central banks, they might try to influence its currency against other major currencies by tampering or doing open market activities. That might include buying gold, silver as commodities, but even for the Federal Reserve of the United States, they might go out and buy British pounds or euros or Japanese yen. Now, when it comes to speculative trading and options on currencies, it's a zero-sum game, which means that there's one winner and one loser. So be careful what position you're actually taking. Some of the tools that are used for international transfers of money are more or less automated in the background of your daily life. So when you use, for example, your Visa or MasterCard in a foreign country, it's all connected through SWIFT accounts, or Society for Worldwide Interbank Financial Telecommunications, or they use chips clearinghouse interbank payment system. So these are a part of the things that happen behind the scenes that you might not see today. But the banks engage in it. They are connected to it. So very often, if you want to actually transfer money from your account in Europe to your account in the United States, for example, is that you need to ask for the SWIFT address. And smaller banks might not have it. So they are typically connected to a hub that does it for them. So make sure that you know and go to the bank website and see what the SWIFT address is, because you need that. It's like your bank's zip code. That way it connects to your bank account as well. So it's not only your bank account and your franchise number and the bank name. You have to know what is their zip code when it comes to foreign exchange trades, so they can match it up. Now, moving money is expensive. So banks around the world, they will consistently net their transactions. That means that if you have a bank in London, a bank in New York, and $200 is supposed to flow to the bank in New York City, and £100 are going to the bank in London, you would have to go in net and see, okay, here we have a bunch of assets and liabilities, it's netting, and then they go back and forth, and once they have done it, they can calculate exactly how much money should actually be transferred back and forth. It's a way that it's netting, so they do this automatically and check it out, and that way they don't have to transfer that much money. Currency quotations. As a consumer, we always pay the highest price, and we sell at the lowest. So let's learn a little bit more about what these quotations actually mean. Now, for the most part, we will not ask, what is a big number? What is a small number? We don't do that. But they do have names, and you need to just pay attention and learn it once, and then hopefully remember for the rest of your life. So we would buy at the big figure. So we would buy where it's expensive. And the little figure, which is selling, would be the lower numbers. So you have the big figure and the little figure, but we would buy at a higher price and we'll sell at a lower price. Now, the foreign exchange broker, they make the spread in between. And remember, they have to make money too. They have to hire someone that sits in the airport and perhaps take care of the little office. They need insurance. They need to have a safe. They need to have a security system. They need the computer systems to keep everything working well. They need to pay rent and insurance and all those things. So that is how they make money. So the spot rate is denominated by the S, okay? Spot rate for the dollars and euros is the current quotation right now. The forward rate is done. The denomination is an F for forward. And pay attention to that if you have any quizzes on it or anything like that, or someone's talking about it. You just have to see the different, what they are. And that's a quotation in the future. What you can expect to exchange money in the future. So direct quotations, or what we will call American terms, will be denominated like this. So the spot rate for the dollar euro is $1.40. Now the inverse, you get that by taking 1 divided by, in this case, so if you took 1 divided by 1.4, you'll get the inverse, which is quoted right here, the 0.7125. So that's a reciprocal calculation. But if you take 1 divided by 0.7, you'll get the 1.4. Here you have an example where you can see the indirect quotation. So if you're from Europe, this is probably how you expect to see the numbers, and not like this. What you need to do if you want to see the inverse of it is that you take 1 divided by this number to get the other. So 1 divided by 1.4, you get the indirect quotation, and if you have the indirect quotation, take 1 divided by 0.7, you get the 1.4, which is the direct quotation. So if you don't have the numbers that you recognize, just divide it by 1, and you'll see something that is easier for you to understand. Now, if you want to do a cross exchange rate, you can take the spot rate for the euro pound, which would be equal to the spot rate of, you have to have cross currencies here, the dollar pound and the dollar euro. And if you take these numbers and divide them, you will actually get the spot rate. Now, here's kind of an interesting part, is that if you do it a different way, you'll actually find a rounding error. And if that held true, you would actually have an arbitrage opportunity to make money. But you have to go the right direction, otherwise you lose money. Triangular arbitrage. This is what the super banks are doing. Well, they're supercomputers at least. Is that they would calculate the exchange rate in between several major currencies simultaneously, back and forth, different directions, several times every second, just to look for an opportunity to have an arbitrage profit. So in this case, we have $5 million that we're actually using for this trade as an example, and we're starting right here. And we take that times the spot rate for the euro dollars, and then we get the amount in euros, and divide that by the spot rate for the pound, and you get another number, and then you have to calculate that back to US dollars again. And if you have a magical positive number, in this case $22,783, that is your arbitrage profit. You should take that trade instantaneously before anyone else can do it, or that opportunity disappears. Now, if you accidentally did it the wrong direction, let's check out what happens. And you go the opposite direction. Okay, you go the opposite direction here, this way. You will actually end up with a $19,323 loss. So that's why you have to make multiple calculations every fraction of a second and different directions, just to figure out whether or not there is an arbitrage opportunity or not. Dear students, I hope you enjoyed this video on foreign exchange. Please like the video if you thought it was good, or write some comments and say, this is what I wish you were covering next time you re-edit this video. And don't forget to follow me, and that way you will actually get the updates as I post new materials. See you soon. Thank you. Take care.